Hey everyone, happy Thursday, June 20th. It's about 8:50 in the morning on the West Coast, and it's time for another market update. A shorter week in the markets this week. Yesterday, Wednesday, was Juneteenth federal holiday, so the markets were closed. Not as much data being released this week, which was kind of a relief. The last couple of weeks been really jam-packed full of data, so it's nice to give a chance to breathe. But there was some important data, starting with May's retail sales. Those came in, the headline came in at 0.1% gain. It was expected to be 0.2. And core went up 0.4%, was expected to be 0.5. So both came in better, lower than expectations, which is good for us. It looks like the consumer is weakening a bit. The less the consumer spends, the less inflation is. That's all good for mortgage rates, things like that. The other thing that happened with these numbers, let's look at this in graph form, is that they made some negative revisions to the previous month. So again, just like with the BLS jobs report last month, they came out. I think the headline was flat at 0%, and now they've revised it to negative 2% or negative 0.2%. And the core was also revised lower. So those numbers this month would actually have been even worse looking if they hadn't made those negative revisions. And it's just kind of disappointing. Just like the BLS jobs reports, these initial numbers come out, the markets react, the Fed reacts, they talk about it, and then the next month they come back, tail between the legs, and say, hey, we were wrong, but we don't get the same market reaction. Looking at graph form of these retail sales, you can see since January 1992, they just keep going up and up and up. These light blues, the recessions, see a quick one there during the pandemic. Things went way down, then kicked way back up. Since then, we've been basically climbing. So we'll have to keep an eye on this. Like I said, the weaker this is, the weaker the consumer is, the better chance the Fed says, hey, inflation's lower, people aren't spending as much. Maybe we should do a rate cut to get people to spend money, which is what we kind of want. Another thing to keep in mind with this will get plugged into the Q2 GDP of the United States. So the weaker this number is, the lower GDP will look, the better that is for us because it looks like some weakness in the economy. So overall, this was a good number to see. Next thing we got the May starts and permits for new builders. They're down across the board. So this is important. This is where we get an idea of, new inventory coming up, either being started, completed, or, future inventories, these permits. So as you can see, month over month, everything was down. Permits down 3.8%, starts down 5.5%, completions down 8.4%. Year over year, the only one that's up is completions. And a lot of this has to do with less multifamily permits being pulled and starts, but there is a lot of completions coming up with multifamily. 914,000 are in construction right now. That's good for future rent inflation. The more apartments and stuff available for people to rent, the lower that will be. But the fact that they're not starting new ones means maybe on the horizon, we're going to have some, more rent inflation there. Overall, these numbers are good for current homeowners, showing, the less homes that are being built, started, and so forth, less competition for you, more your house will appreciate. Not as good for people wanting to see, a bunch of more inventory in the market, make prices come down, things like that. Builders are just not building as much. For them, just like for, people, rates are higher. So, when they're doing these projects, when they're, trying to build 500 homes, it's just not penciling out if the cost of land is higher, the cost of materials is higher, the cost of the contractors is higher, and the cost of rates for their loans that they're doing to do business is way higher. So, less inventory, good for current homeowners, not good for people wanting home prices to come down. Next thing we got, initial jobless claims, 238,000 new claims. Expected was 235, so a little bit of expectations. Continuing claims were up again, so people are having a harder time finding jobs once they do get laid off. And so, still at pretty low numbers, but this will be the sample week that will get plugged into the next BLS jobs report. So that's good for us because this is, higher than they have been. So hopefully that, translates over to that BLS jobs report, and that number comes in more favorable, which would be good for rates and so forth. So jobless claims, unemployment, layoffs, job openings. That's all we got to keep track of, look at to see how this job market's doing. So the Fed is paying so close attention. Next thing that we got, so miscellaneous. So the CBO, the Congressional Budget Office, came out today and they upped their estimate of our deficit in the country from $1.6 trillion to $2 trillion. So the government keeps spending. It's good to see, retail sales, the consumer stop spending, but the government is spending even more and more and more. This is not good. This, translates, the more they're having to sell off U.S. treasuries, which will hurt the bond market, treasury market, things like that. So, not a good one for the bond market today. The market's react negatively, basically just showing that the government keeps spending money, and, overall, it'd be better for us if they didn't, if we want rates to come down. And then the next thing, CoreLogic Rent Index came out, the blended rent. So new rents and renewals came out at plus 3%. It was last month it was plus 3.4%. Still, way ahead of where these inflation reports that the Fed's looking at have it. So the CPI report came out recently. it was at plus 5.3%. So 2.3% below, in these more, current numbers coming from these, this data set is much better for us than what the CPI and the PCE reports pulling, because we know that stuff is playing a big part in that core inflation, and that's what the Fed's paying the most close attention to. So again, it's good to see that rent's coming down. It'd be better to see if we saw it coming down in that CPI and those PCE reports even more, because that would be, that would get that inflation number down where the Fed will be more likely to cut rates, and that's ultimately what we want. Next thing, so the average 30-year conventional ticked up from 6.97 last week to 7.05. Maybe he's been hanging around the 7 number for a while. It's threading that 7.5 a couple times. It dropped down 6.6, 6.5 kind of range a couple times. Obviously, we want to come down, but at least we're not having a jump. Or at least we're not at above 8 where we were at one point last year as well. And then upcoming important dates. Next Friday's the big one. We got the PCE jobs report coming out. The core PCEs, the Fed's favorite form of inflation. We're kind of a little hopeful for this because the CPI, the other inflation report, came in a little lower. The PPI, the producer inflation, what gets plugged into this, that came in a little bit lower. So, fingers crossed we get a good number here. This would be our best chance to see some, positive movement. BLS jobs report a week or so after that, that will be the big one, like it has been. If we get that unemployment number to tick up from 4.1, 4.2, maybe that changes that, the Fed's July meeting outlook on July 31st. Right now, the markets are saying about 10% chance they would cut rates at that meeting, and then about 63% chance of their September meeting. But inflation comes down more than expected. We start seeing a lot of weakness in the job market before that July 31st meeting. That would be our only chance to see that rate cut expectation jump up into July. So fingers crossed there. Don't want to see a bunch of people lose their jobs, but more so, we want to see them accurately count the data, and I don't think they're doing so currently. So if anybody needs anything at all, please don't hesitate to reach out. Otherwise, I hope everybody has a great week. Thanks, guys.